2023 was a fantastic year for the Magnificent 7 stocks. While the S&P 500 increased by 24% that year, the Magnificent 7 stocks generated a whopping 76% return. But by April 2024, only 3 out of the 7 stocks have outperformed the index so far this year. And no prize for guessing which is the lousiest stock of them all, Tesla. So the question is, will they continue to dominate, or will they eventually be kicked out and replaced by another stocks, much like what has always happened in the past? And given that the Magnificent 7 stocks have such a big weightage in the S&P 500, should you start diversifying away from them to reduce your concentration risk? Or given that there are huge potential to what big, should you add on more? But before I start, do join my 8,000 members Telegram chat group to discuss stocks and personal finance. While the term Magnificent 7 gained popularity in 2023, they didn't just pop out of nowhere and started doing really well that year. Instead, their outperformance started more than a decade ago during the tech boom in the 2010s. And just in case you're wondering, this chart includes Netflix. That's why it's called Mega 8 instead. Due to this outperformance, just the top 10 holdings alone now make up over 32% of the index, the highest concentration we have seen since the 1980s. And these outperformers are all real, yeah? And it isn't just based on some random memes on the internet, like GameStop. The Mega Cap 8's contribution to S&P 500 forward earnings as well as forward revenues have indeed been increasing throughout the years. Likewise, the forward profit margin is also higher than S&P 500's forward profit margin. So is the Magnificent 7 cheap now? Even though their forward PE has came down from the peak in 2020, they are still higher than pre-pandemic levels. And it's not just them, because even if you exclude the Mega Cap 8 companies from the S&P 500, the S&P 500 currently still have higher forward PE. This is because investors are now expecting these companies to continue doing well in the future. Why? Because of AI law. For example, during the latest earnings calls in Q4 2023, almost half of the companies talk about AI during their call. And those companies that talk about AI saw better performance in their stock prices. So how sustainable is this? Check this out. I took their current stock price and compared them to 2 sets of fair value prices. One by Morningstar and another by Professor Damodaran, aka the Dean of Valuation. And what I found was that most of the Magnificent 7 stocks are trading rather close to their fair value, with price differences of between positive 15% to negative 20%, except for Damodaran's fair value estimate of Nvidia, which shows that Nvidia is overvalued by more than 50%. However, keep in mind that he came out with this number in early February 2024. And since then, Nvidia has reported new earnings and have forecasted even higher growth in the upcoming quarter. So his fair value is a little outdated, yeah? But what's also surprising is that even Tesla, which many people feel is super overvalued now, is considered undervalued when we look at its fair value. But of course, all these numbers are just based on assumptions, yeah? So don't go and be like, oh, Kelvin say it's undervalued, let's go all in on Tesla. Assumptions can be wrong and will change whenever there's new information, such as new companies' earnings, new interest rates, or new global events. Then one common question I often get is, if these 7 stocks can perform so well, why even bother with S&P 500 ETF or QQQ? Why not just buy these top 7 stocks and what big? In fact, there's even an ETF called the MAGS, where you invest in just the Magnificent 7 stocks. Based on history, this might not be such a good idea. Here's why. First, top stocks rarely stay at the top forever. For example, back in the 1930s, AT&T and General Motors were the largest companies in the US for a few decades. But as better companies appeared, they slowly fell out of the top 10 list. Likewise, back in the 1960s, there was the Nifty 50, which contains 50 large cap stocks that were regarded as solid buy and hold growth stocks. And just like the Magnificent 7, they helped propel the bull market back in the early 1970s. And like always, they eventually became overvalued and eventually crashed hard. How overvalued? Well, at their peak, they had a median PE of 41. But as of March 2024, the Magnificent 7 had a PE of 37, which is pretty close to Nifty 50's peak. This video is brought to you by CMC Invest and SingSaver, which is giving you up to $450 worth of rewards. All you need to do is open a CMC Invest account via SingSaver and you will receive a $20 cash via PayNow. And when you meet the minimum funding and trading requirements, you can also receive up to 1 NVDL share, 1 Nike share, and 1 Tesla share from CMC Invest. The rewards can be stacked. So let's say if you fund 1000 SGD and make 6 trades, you will already get a $20 cash, 1 NVDL share, and 1 Nike share. But wait, that's not all. All clients will enjoy a complimentary 12-month upgrade to their Invest tier, which gives you a total of 45 money-free trades in Singapore, US, UK, Hong Kong, and Canada, as well as a 0.2% FX settlement rate, which is perfect if you like to DCA into stocks like your tech stocks. What I like about CMC Invest is that you can invest without the fear of unexpected fees. All the fees are clearly stated before you place your trades. They are also part of the CMC Markets Group and backed by 30 plus years of trading excellence in APAC, UK, Europe, and Canada. So if you are interested, you can sign up with my link down below. And let's get back to the video. Back then, the Nifty 50 group was a much less exclusive group than the Magnificent 7. And more importantly, many of the companies were running ordinary business instead of dominant ones like the big tech that we have right now. So for now, the Magnificent 7 will likely continue to dominate in the near future. But just keep in mind that they won't continue to dominate forever, yeah? Which brings us to the next point. Given that they are so big now, it's very likely that they will underperform in the future. For example, this chart shows that before companies became big, they tend to outperform the market. And after becoming big, they tend to underperform the market. This is because even though AI may help to boost the profitability of these companies in the medium term, a lot of upside may have already been baked into the prices, like Tesla. So the moment they start to underperform, that's when they will start to boom and crash. In fact, most of them have already crashed once in 2022, where, for example, Nvidia crashed by 66%, Facebook 77%, Google 45%, and so on. Though most of them have already recovered since then, except for Tesla. Also, maybe you don't believe that they will crash, and you will point that, oh, Apple released their latest iPad and they'll be integrating ChatGPT into iPhone. Where got bad news or? The thing is, narratives change all the time. Like, remember back when Meta announced that they are plowing billions of dollars into Metaverse, the market reacted negatively and people were saying that Mark Zuckerberg was delusional. Then this year, Meta tripled their profits and issued dividends, and all of a sudden, Meta is a good stock all over again. This is despite them still spending billions of dollars on their Metaverse. Likewise, while Apple may seem like a solid pick now, with the high switching costs, customer loyalty, and brand monopoly. But the moment things turn bad, the media will say that the iPhone sales have slowed down, their revenue has plateaued, they are exposed to China risk, and so on. Similarly, Google is a bad stock when they were laying people off, ChatGPT are stealing their search business, and their AI gave wrong info. But now, Google is back to all-time high again. So there's always recency bias, where all these companies will seem good when times are good, and will seem lousy when times are bad. So what should you do now? Should you buy more into the Magnificent 7, sell away, or just do nothing? Bank of America now expects more of the S&P 500's return to come from outside of the Magnificent 7 and are warning investors about the risk of becoming too excited about the big tech. But as Bloomberg said, S&P 500's tech-heavy top is a feature, not a bug. It's not an issue even if these stocks were to do badly in the short term, as they are the top companies for a good reason. There's earnings growth, have strong moats, and they continue to heavily reinvest back into themselves, which will propel future growth. So even if they were to crash, as long as their fundamentals remain strong, they will eventually recover. So you don't have to purposely diversify away from the Magnificent 7 stocks, but at the same time, you shouldn't ignore other stocks too, as there's still good stocks to be found elsewhere. One such example is Adobe, which has an equally strong moat, but has been sold down for almost 25%. So if you like stock picking, you can go hunt for these stocks. Otherwise, a much simpler way to invest is to just buy indexes that hold all these stocks, such as S&P 500 or QQM, because you won't buy the wrong stocks if you buy everything. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.